What's up, freaks? This was brought to you by River. River's a Bitcoin company built by Bitcoiners for Bitcoiners the right way. There's no trusted third parties. They build all their infrastructure. They have free DCA because they know it's the best way to buy Bitcoin. So if you want to buy Bitcoin, you want to mine Bitcoin, you want to send Bitcoin over the Lightning Network, you want to plug into their Lightning Network API. If you're a developer, they're building all these tools for you. They also encourage self-custody. Again, they're Bitcoiners. They want to provide an on-ramp for you and then teach you and encourage you to take control of your own Bitcoin. And they're doing this. It's a beautiful company. If you do hold Bitcoin on the exchange, you can know for sure, since they don't rely on any third parties, they don't lend your Bitcoin out, they don't speculate with your Bitcoin. Your Bitcoin is held in a multi-sig wallet with 100% reserves. Okay? So go to river.com/TFTC, take advantage of the no-fee DCA. You set up your dollar cost average. You don't pay any fees on those buys. If you're a developer, they have their Lightning Network Services API that you can build on. You can send over Lightning. You can mine via River as well. You may have your exchange. You may be comfortable with it, but have you tried River yet? It's a question you have to ask yourself. If the answer is no, go try it. That's where all the Bitcoiners are hanging out. That's where I get my Bitcoin as well. River.com/TFTC. Thank you guys for listening. If you're listening on YouTube, please subscribe, set the notifications up as well. We're going to be putting out a lot of content this year. If you want to subscribe to the podcast feed as well, if you're not around your computer or not listening on YouTube, but you want to catch the podcast on the podcasting feeds, subscribe on your favorite podcasting app. And if you want to learn more about Bitcoin, I write a newsletter almost daily during the week. Go to tftc.io, subscribe on the website, and you'll get pure signal on Bitcoin, macroeconomics, geopolitics, whatever tickles my fancy that day. Thank you guys for joining us. Thank you for supporting the show. If you can subscribe, rate, review, goes a long way. We're trying to blow this up in 2023. Enjoy the rip.
You've had a dynamic where money's become freer than free.
If you talk about a Fed just gone nuts, all the central banks going nuts.
So it's all acting like safe haven.
I believe that in a world where central bankers are tripping over themselves to devalue their currency, Bitcoin wins. In the world of fiat currencies, Bitcoin is the victor.
I mean, that's part of the bull case for Bitcoin.
If you're not paying attention, you probably should be.
Lyn, welcome back to the show.
Thanks for having me back.
It's been too long, but
I agree.
But I'm excited we're talking today. We were just mentioning that Jerome Powell's on Capitol Hill getting grilled. I forget if it's Congress or the House or the Senate, but he's getting grilled. And we were just mentioning, it's funny, he essentially had to admit to Kennedy that the Fed's policy is probably going to drive up unemployment unless the fiscal side comes in and helps him out with the inflationary pressures. But you were mentioning that this historical tie between inflation and unemployment doesn't really materialize, but it is the Fed's mandate to really focus in on these two metrics alone.
Yeah, it's a really weak correlation. It came about back when labor was more domestic in general, right? Less globally interconnected. And the general idea is that if, the economy is running too hot, they can tighten money, they can raise rates to try to, make it run a little cooler. On the other hand, if it's running too, slow, they can loosen money and try to get more people back to work. And of course, there's been major decades of stagflation. We have high unemployment and high inflation. If you kind of map out the long-term relationship between unemployment and interest rates, it's a very weak correlation overall. And yet the entire institution of the Fed is basically based on this relationship being extremely tight, right? Their mandates are, basically price stability, which they currently define as 2% average inflation per year, the way they measure it, and optimizing long-term employment. And so they kind of inherently have this relationship built into their DNA. And so it's kind of like, they're operating on a certain algorithm that might or might not be applicable, and more often than not is not particularly applicable. But that's kind of what they have to do legally, and so it's kind of it's an interesting system, and it's I think we're at the phase of the long-term debt situation, the long-term fiscal situation, where interest rates and overall monetary policy are going to be increasingly politicized. The last time government debt as a percentage of GDP was this high was at the 1940s, and the Fed was essentially captured by the Treasury. Basically, they had to make interest rates, at a level that was, in line with how much debt and spending were happening at the public level. They had to keep them low despite high inflation. And now, of course, we have a different degree of central bank independence, but I think that's going to be increasingly challenged. And there's the two interesting sides of that are, one, I think some of the challenges are appropriate in the sense that you can say, does your model even make sense, right? So they can ask Powell, like, does your focus on creating more unemployment, is that actually going to bring down inflation? On the other hand, on the public sector side, a lot of the inflation we're seeing is fiscal driven inflation, and so there in many ways is that their decisions over decades have contributed to this. It's part of the underlying money creation mechanism, and so they're kind of facing their own problems, and so I think that's going to be a whole thing this decade.
Yeah, it reminds me of a conversation I had yesterday with Kelly Lannon. We were talking about real estate market, but we dove into the railroad infrastructure, and that being a shining example of something where the maintenance on these railroads has obviously been subpar. Railroad operators are like, all right, it's good enough to get it from A to B, but if inflation gets too high and you destroy any possibility of actually maintaining the railroads, you could have breakaway inflation because if they break down, you can't fix them. No matter what you do, you're not going to get supply to where it needs to be. And so if you can't buy something, it's just going to drive up the price. It becomes more scarce.
Yeah, if you challenge the whole relationship between labor, unemployment and inflation, basically it's, who would look at inflation and think, okay, we have to make sure fewer people work now. We have to make sure fewer people are providing goods and services in order to get inflation down, right? That doesn't make sense, right? It's basically a very demand-driven lens. It's like we need fewer people working so they have less income to buy things. That's kind of the assumption. But they're ignoring the fact that those people are also working, which are producing the supply of goods and services. You want maximum employment all the time, if possible, because that's where our supply side comes from. And so some of the things that they do risk hurting the supply side, which is a large part of where this inflation comes from. Basically, we have a tightness of real world constraints, energy, labor, especially the types of labor we need, people that can build things and maintain things. On the other hand, a lot of the excess demand we have is coming from that fiscal component, which is not going to be affected by monetary policy. It's actually made worse by monetary policy in the sense that if you have deficit-driven inflation and you raise interest rates meaningfully and hold them there for years, then it's larger deficits. That's actually more money pouring into the economy, and so it's just kind of an interesting dynamic. And I agree with you that basically the inability to build or maintain things is going to be a key theme for a while, because that's not something that you can change very quickly. That's we've kind of undermined our industrial base for decades. We've prioritized certain types of work over others by the nature of our system, right? So if you work in technology, healthcare, finance, government, you're doing pretty well. But if you worked in a physical trade, it's an uphill battle the whole way. And so we've kind of disincentivized that type of work. And so it's not shocking that we have pretty structural labor shortages in that type of thing.
Yeah, it's pretty alarming when you put it all in context, and then bringing it back to the Fed, again, with their dual mandate of price controls and stable job markets. It doesn't seem like they're achieving their goals with their aggressive interest rate policy at all. I mean, obviously, the CPI print has come down a bit the last couple of months, 6.4% in January. However, if you dig in to the individual verticals within CPI inflation, food still above 10%, energy's around 8.2. Yes, natural gas and gasoline prices have come down, but this could be a temporary lull in a bull market for energy, especially if you consider that China's going to open up their economy. So, like, is this the last gasp of the Fed? When I'm looking at it, it seems like their interest rate policy has been completely ineffective, because CPI is coming in at 6.4. That's growing on a bigger base that was set last year, number one. And then number two, I read a newsletter about this last night. Like, shrinkflation is becoming more and more prevalent as well, which is not being reflected in the CPI either. So I think everybody who listens to this show and has been for years knows that I think CPI is completely bunk. But even though it's well above the 2% target, I think it's severely underscore or not reflecting the actual inflation that exists in the economy. And if actual inflation is much higher than the CPI and the Fed is proving to be completely ineffective, where does that leave us?
So I think, yeah, we definitely have to analyze the path dependence here. So for one, I do agree that CPI has historically understated actual inflation. Basically, and one of the biggest components is how they redefine shelter. There's also challenges, obviously, with hedonic adjustments. One of the things I like to do in history is look at a handful of things that just don't change, like beef, gold, bacon, oil, a barrel of oil, and look at the price of those over a very long period of time. And some of those are obviously very volatile in a 10-year period, because you have, obviously big supply comes online, and then there's periods where there's not enough supply. But if you look at them over the course of like a 50-year period, most of those things have gone up faster than the CPI. Because CPI, you're constantly adjusting towards cheaper things, and you're factoring out some of the appreciation in real estate, because they're using owner's equivalent rent instead of housing. There are brief periods where CPI could ironically overstate inflation. Like if you have house prices stagnate for a while, and their shelter component is like operating on a lag, because it's kind of this like janky calculation. You can have this like brief window where like CPI is actually, overstating inflation, because real inflation is more volatile than their calculation will get to. But the majority of the time, I think it's generally going to understate it. As for basically the path dependence here, my base case early last year was that they were going to tighten into a recession. They would probably get the inflation down. And then, because the underlying problems are unresolved, when they try to loosen, when they try to have another growth phase, that inflation is going to come right back, right? Until you basically fix, the combination of structural fiscal deficits and fix the energy supply and transportation problem globally. As long as those two pieces are there, inflation is ready to bounce back whenever there's a period of growth. And so that was the base case. We're starting to see early signs that they might not even be able to get inflation down as much as they wanted before the next cycle of inflation. I'm not quite there yet in terms of saying that they can't. I still think they have a window here where they can cause so much private sector damage that they might be able to temporarily get inflation down. But I think the main problem is that it's just ready to go. It's ready to come right back as soon as they have another growth cycle, as soon as they let their foot off the brake for a brief period of time. And basically, they're using 1970s monetary policy to fight 1940 style fiscal driven inflation. So, if you look at over time, the inflationary decades that we've had in the United States and elsewhere have had very different reasons for why that inflation exists, right? So the 1940s, banks weren't lending much, but instead the government was running absolutely massive monetized deficits, and that was the source of money creation and prices going structurally higher. In the 70s, you did have deficits, but they were much smaller, and that was the peak period for bank lending. So basically the credit multiples constantly going up. Banks were lending aggressively. You had baby boomers were entering their home buying years. Then you combine that with oil shortages. So you had both supply side constraints, and you had tons and tons of bank driven money creation. And so back then, one of the main tools they used was trying to slow down that bank money creation with tighter monetary policy. That's basically the Volcker playbook. They also did a bunch of geopolitical things. I mean, they went after unions to try to get domestic labor from going up like it was. They tried to open up global trade. So they did a lot of other things in addition to monetary policy. But basically, that tight monetary policy made sense in an era where banks were doing most of the money creation. Whereas in the 1940s or the 2020s, when most of the money creation is fiscal deficit spending, when you raise rates, it doesn't really change what the government's going to do. I mean, they're going to spend what they're going to spend, and now they're just actually pouring even more money into the economy with their deficits because they're paying such high interest rates on them. And so it's kind of interesting to see them do the 1970s playbook for a 1940s problem. And in my mind, it just shows that even if they temporarily get inflation down, they don't fully understand the nature of the problem, and so it's ready to come right back.
Yeah. No, I mean, the interest expenses on the debt have been a big theme in the news over the last few months, approaching $1 trillion annually, which, what would that be in 2022? Or excuse me, 2021 tax receipts. 2022 isn't in yet, but we're tax receipts like $4 trillion around there. So yeah,
something like that. Yeah, it'll be a very big percentage. It's also rising as a percentage of GDP. Basically, ever since, when you look at public concerns around the debt, they peaked in the late 80s and the early 90s, right? So if you look at interest expense over time, it was going parabolic in like the 70s and the 80s. And in the late 80s and the early 90s, it reached a peak as a percentage of GDP. And that's because you had rising deficits and you had high interest on those deficits. And that's, for example, the famous national debt clock was installed in the late 80s. Also in the early 90s, you had the most successful third party candidate in American presidential history, Ross Perot, and he big thing he ran on was the debt. That was like a big theme that was like really, it got the public attention at that time. And a lot of that was kind of like 3 decades early, because what generally happened over the next couple decades was you had this, rapid period of globalization, lower inflation, lower interest rates. And so even though debt as a percentage of GDP kept going up, the interest expense kind of stagnated, especially relative to the size of the economy, and it went down for a period of time. And so you had basically 4 decades of rising debt as a percentage of GDP and 4 decades of falling interest rates offsetting that. And now we're in like the awkward part of the cycle where debt as a percentage of GDP is still going up, but those interest expenses are not going down anymore and might start trending higher. Certainly in the near term, they're trending higher. And so that's when you actually revisit those concerns of the late 80s and early 90s and say, okay, basically, they were early, but now we're actually getting to the phase where some of the things they're worried about are more structurally occurring now, and there's a lot less wiggle room to deal with them.
Yeah, and it seems like it's only going to get worse. Like I was mentioning, I was following up on Powell's comments on Capitol Hill today. I saw the probability of a 50 bip hike during the next meeting jumped from, I think, 39% to 59% during his hawkish comments. And so that's only going to exacerbate the problem. Then the question is, does the U.S. have the political will to do what is necessary on the fiscal side? I'm not so confident. How are you feeling about it?
I don't think they do because, a couple reasons. One is just the political polarization makes it almost impossible. Basically, they're not going to most likely trim any sort of intermediate term entitlements. A lot of these things are baked into the cake from decades ago, and demographics. They're not going to probably trim military spending, especially what's happening geopolitically. I think you could ask reasonable questions like, do we need 750 foreign military bases? I would say no. Like, you could probably trim that number down, but I don't think that in this era is when they're going to do that. And I also don't think you're going to get much, if any, tax increases, because it's, the Republican side is probably going to be pretty adamant on that. And so when you add both sides together, one side doesn't want to cut military, one side doesn't want to cut entitlement, one side doesn't want to cut taxes. And then if you look at kind of the Trump wing of the Republican Party, he's strongly in favor of keeping Medicare and Social Security there. That's kind of how he's been differentiating himself from other players in the Republican field that have historically been more in line with cutting those. And so I think basically the current political environment makes any sort of meaningful cuts to the fiscal deficit very, very hard to do. And then a further complicating thing is if you just look at kind of the history of debt to GDP for countries in the world, once you get this financialized and you get this high public debt to GDP, even if you were to do those cuts, it would probably also negatively impact GDP so much that even though you'd rein in the deficits at first, you'd actually probably still keep increasing debt as a percentage of GDP because a lot of that GDP only exists because of those deficits. If you have like say 50% public debt to GDP and your deficits are getting a little wide and then you do austerity, that works, right? Because you didn't let the problem get so big that your GDP is reliant on those giant debts and deficits. Whereas once you get over to like 100% debt to GDP, austerity often backfires because your GDP is already so financialized. And so it's kind of this thing where it's inevitably going to go through a very hard period. And, I think they might have attempts at austerity. We kind of saw that in Europe after the European crisis of 2012, all that debt crisis. There were like these attempts at reining in the deficits. I mean, you got Italian deficits down to like 2% of GDP, which for is their attempt at austerity. During the kind of the period where Obama was president, but then there was a Republican power in Congress and Senate, you had that gridlock. And so you actually, for a while, you had falling deficits as a percentage of GDP as they kind of locked in the existing structure. But that started, blowing out when you started to get entitlements, kind of that demographic peak started to come and manifest. And then also you got, Trump stimulus tax cuts that were not offset by spending. And so basically, no matter what arrangement we have in politics, this kind of train is already going. Like the momentum is so strong for it.
Yeah, we're in the damned if you do, damned if you don't stage. And considering that the 2024 election cycle is beginning to heat up, I find it very hard to believe that anything on the fiscal side will change moving forward. It's just too politically untenable during an election season. And then that gets to the broader question too. Like we've been focused very specifically on like U.S. policy. Obviously, over the last year to 6 months, many countries outside the U.S. have seen the sovereign reserve seizure of Russia. They've seen the turbulence here in our economy, and they're beginning to position themselves, particularly countries like Russia, China, and Saudi Arabia, to buddy up with each other and begin maybe defecting from the U.S. dollar reserve system in some way or another, slowly but surely. What do you think the ramifications of the turmoil we're seeing in the U.S. economy and our inability to tame inflation is having outside the U.S. in terms of other countries beginning to look at alternatives?
Well, I think in general, we're shifting towards a more multipolar world. If you looked at, gold as a percentage of sovereign reserves, for example, or just the number of tons they have, they were on this like structural decline from like the 70s until like 2008. Basically, you had rising dollar dominance and you had falling gold dominance. And after 2008, when we basically just printed the difference, like when our bank system blew up and we just printed, you started to see this like reversal. And foreign central banks started buying more gold again, and they've actually kind of gotten back up to like significantly pre 2008 levels. So that was like one factor. Number two is you had China Belt and Road Initiative. When they launched that, it was something like 2013. They basically came out with an announcement, and they just said like accumulating treasuries is no longer in our national interest. And so what they started to do instead was take a page from the European and American playbook of like monetary, like neocolonialism, where they say, okay, we're going to start, instead of like taking all of our dollar surpluses from the trade surpluses we're running with the Americans, instead of like putting all those dollars back into U.S. assets, we're going to start making dollar loans to African countries, Latin American countries, Central Asian countries, basically help them build infrastructure that kind of all leads to China. Buying commodity rights, that kind of thing. If they default on any of that debt, that basically some of those rights go over to China. And so they've kind of, tied themselves into this global euro dollar market to a significant degree instead of buying treasuries. And Saudi Arabia, instead of just constantly taking their petrodollars and putting them into treasuries, they're putting things into like, their sovereign wealth fund, kind of these, for a while, they were really into these big tech growth type of stocks. They're doing domestic development. They're doing all sorts of partnerships. And so basically, a lot of these countries are saying instead of just this current system that was in place for decades, we're going to start investing our dollars elsewhere, at least around the margins. So it's not like we're dumping all of our treasuries tomorrow, but it's like we're just not going to keep accumulating our stockpile and might even trim our stockpile like China's done. And so I do think we're shifting towards a more multipolar world. There's obviously challenges there. I mean, one, they can settle in gold, but they still have all these like payment centralization issues. And so you see them working on what is it, Enbridge or something, where they're basically they have like this like blockchain thing they're working on with the BIS to see if they can like settle things outside of SWIFT. All these alternative payment systems. Russia has theirs, China has theirs. Some of these collaborations. And there's ongoing frictions there, but I do think a general trend is there's a pretty adamant shift towards, with the combination of more multipolar payments and more multipolar reserve assets. Instead of just dollars, it could be gold, could be yuan, could be others. If Bitcoin gets big enough, that gets interesting, but it's not, right now at the size it is, they're not really, it's more about gold and currencies and, equity types of investments. And I think that's the general trend we're on, is that more multipolar. But it's funny because there's weird frictions. Like, for example, India is another country that has kind of broken out of the Western consensus. And they said, well, I mean, we're going to basically buy all the spare Russian oil then, right? Because then they literally said it. They said, look what's happening to Sri Lanka. We're not going to have that happen here. So we're going to buy whoever is going to sell us oil the cheapest. So India started buying a ton of Russian oil, and they already had plans in place to expand trade with Russia anyway. And one of India's goals was to buy oil in rupees. And that was promising for a while, but the problem is now they're actually buying so much Russian oil, and Russia doesn't want that many rupees. Basically, India's running a pretty big trade deficit with Russia. And so that actually creates like a settlement problem. And so there's always these like weird frictions they run into when they're trying to have like this big fiat barter system we essentially have in place. We have 180 different fiat currencies, and whenever they're trying to do global trade, it's kind of a nightmare for them to work through, and it's a slow process.
If only there was a politically neutral distributed monetary system that these people could use to settle their trades with.
If only.
Well, I guess we could dovetail into like the whole Bitcoin conversation. I mean, I think we both agree that it is a superior settlement network, but with that being said, the liquidity profile of Bitcoin probably isn't where it needs to be to settle these types of trades on the international level. Do you agree with that?
I agree. I think you need a 10x, right? I mean, if you look at oil trade, I mean, it's we're talking trillions a year in oil revenue that has to be settled somehow. And the depth of the Bitcoin market is not really in line yet with global trade numbers. And so it's certainly possible for like these smaller countries to explore with it. There's also just career risk, right? I mean, if you're like the finance minister or the central bank, executive, and you say, hey, let's do Bitcoin, and then it crashes, 80%, and like you're the one that gets fired basically. So it's like there's limited upside for you, and there's plenty of downside for you. So there's kind of this institutional inertia that makes experimentation challenge. They'd rather explore partnerships and things they can control more. So I think it's more of like this window where gold and FX are kind of the instruments of the central banks, and Bitcoin is kind of left for the people at the moment. And I think if the people get it, if they add another zero to its like price and market cap and liquidity profile, then it becomes harder and harder for central banks to ignore, and the more interesting it would become to them as both a payment rail and a savings instrument, because the overall liquidity and robustness and kind of durability would be all improved in their eyes. So I think that's kind of what we're on now. And if you look at China, for example, I mean, they're trying to solve like India's problem there of like buying too much oil with rupees, and then Russia not knowing to do with the rupees, and therefore not really wanting rupees. China tries to solve that problem by having Chinese convertibility to gold. It's hard to get money in out of China, but it can go through gold to a certain extent. And so they basically say, well, if you get too much Chinese yuan, you can use it to buy gold, right? And so that's one of their mechanisms for trying to solve that problem. And I think that's a decent like intermediate term mechanism that is, interesting for a lot of countries. But yeah, ideally you'd have something that doesn't rely on that type of centralization, that type of counterparty risk, and something like Bitcoin. It just has to be bigger, I think.
Agreed. And I actually don't mind this order of operations, getting it into the hands of
I agree.
individuals first.
I agree.
Before the central banks adopt it. I like that. And it's very interesting. Obviously, we're both deeply ingrained in Bitcoin. I saw you tweeting this out the other day, maybe last week, but everything we've discussed up to this point, the monetary and fiscal situation here in the U.S. and the reaction to that situation outside the U.S. in parallel with all this chaos going on in the macroeconomic and geopolitical landscape. People are building out the Bitcoin network, adding more accessibility to it, utility to it, and beginning to inject it into other open protocols, whether that be RSS or things like Nostr. Like, what is your current view on what's going on in Bitcoin?
So I'm really optimistic about it. I think Nostr has been really exciting, right? Because you're, in addition to having open transfer of value, you have open transfer of information, which is, hard to stop. So I like these layers that are building and working with each other. I like the proliferation of Lightning in general. It's still very small, but it continues to grow, pretty rapidly from that small base. It's hard to measure some of the statistics with it, but there's been really good reports by Arcane Research and by River that kind of lift the veil on the part of the network that they can see and that they have exposure to, combined with some of these other statistics we have looking at the network. So I think that's really promising. And one of the things I'm really interested to watch this year and in the years ahead is things like Fedi mints. These other types of open source protocols that can, shift some of the balance a little bit. Because one of the problems you see in developing countries is you hear of all these great like statistics for like Bitcoin adoption and stablecoin adoption, whatever the case may be, and a lot of it is like Binance, right? A lot of it is like everybody has these custodial accounts with Binance, and so there's this gigantic global centralized honeypot that would devastate millions if that were to all be taken from them or otherwise disrupted. And something like Fedi mint, and of course there's companies built on it, and there's also other implementations of Chalmane eCash. But basically these ideas of using Chalmane eCash I think are interesting because it tries to localize some of the custody. It basically says, well, don't trust Binance with your money, don't trust exchange XYZ with your money. Instead, either self-custody it, or if that doesn't make sense economically yet, or if you want privacy benefits, then basically it's tools to allow communities to build their own full reserve community banks with inbuilt privacy and convenient transactions. So I think that's one of the things I'm excited about, is trying to decentralize and spread out some of those custody and other risks. So you don't have like, so-called decentralized protocol, but everybody using these gigantic honeypots. Even things like, as cool as like say Wallet of Satoshi is, and it's super convenient, but it'd be nice to see a more private version of that and like a bunch of those that are kind of split up. So you don't have like all, custody kind of centralized, and you say you get, okay, all the UX conveniences of that, but with a better privacy and a better, more fractured custody situation.
No, agreed. And when it comes to Fedi mints, the private payments aspect is just the tip of the iceberg. The modular nature of the Fedi mint protocol and the front ends like Fedi that are being built on top of it is going to really expand the design landscape for more complex applications. I mean, the one, obviously I'm very bullish on just pure Fedi mints for private quick payments with a better custody model than Wallet of Satoshi, but like I'm not sure if you have read about the idea of Fedi pools. Like that's another centralizing factor within the Bitcoin ecosystem right now, is mining pools, and this concept of a Fedi pool being able to spin up a federation of block constructors who can really distribute the risk of block construction at the pool level via a Fedi mint, and then provide more private payouts over Lightning, which is something that many miners have wanted for years. The ability for something like that to come to market is massive. And then you get into the whole concept of being able to create DLCs within these Fediments, more robust smart contracting capabilities. Like payments is just the tip of the iceberg. I don't think people realize the power that's about to be unleashed with these Fediment front ends.
I agree. I think people are sleeping on it, and because a lot of them, as soon as they hear custody, they're not interested. And I think a couple ways to break that up is, one is just that custody is so centralized that breaking it up is just already a better step. Two, privacy in many aspects of dealing with ecosystems sucks still, right? And this is a huge privacy gain. And then, like you said, basically the modular nature allows all sorts of stuff that we've not even thought of to be built if some degree of Fediment usage in communities start to proliferate. And even just as a user myself, I mean, even as someone who does self-custody cold storage Bitcoin, I would like to use a Fediment wallet because the private incoming and outcoming transactions, and if the balance gets above spending cash, you pull it into cold storage. And so it's like separating what you use as your daily spender versus what you do for like long-term sovereign store value type of application. And I think the cool part about Bitcoin is that people can interact with whatever parts of the stack that are most useful to them. If they want to have a few $100s in savings, if they want to do a lot of payments, if they want a lot of privacy, something like Fediment is really useful for them. Over time, when this kind of proliferates more and these front ends develop a little bit more, and obviously if you want to store Bitcoin for like a very long period of time, obviously multi-sig, cold storage, that kind of thing is really important, and people can choose whatever parts of the stack are they need for their purpose at any given time.
Yeah, more optionality is always good. For all the Bitcoiners out there saying, "Oh, this is terrible," you don't have to use it.
Yeah.
I'm a big fan of more optionality and more functionality with this particular option. I think is going to be massive for Bitcoin adoption globally, which dovetails into another question is like, what are your thoughts on Bitcoin adoption moving forward, and what will be the driver? Will it be Western countries trying to use it as a store of value? Maybe some people in the traditional financial system realizing that it is good collateral. Maybe if you mix it with some of the credit products that are looking desperately doomed to fail in the U.S., that it may catch on there. Or do you see Bitcoin adoption in the next 3 to 5 years being driven maybe in emerging markets?
I would like to see emerging markets be the spearhead. I like that kind of decentralization of power. They're the markets that need it the most. I think a lot of them, basically, if you're trying to send money in or out of your country, if you're trying to do work for global people that would like to pay you, then obviously something like Bitcoin Lightning is super useful. And so I think medium of exchange can drive it in areas that are lacking good payment infrastructure. And have all these frictions built in and currency problems and things like that. I think Fediment and various front ends can accelerate that by making it easier, more accessible. Like you said, in the West, I think for now the store value aspect is more impactful for many people because they have relatively good payment infrastructure most of the time, and so for them it's more just like this. They view it as like an investment, kind of like any other investment. So I think those two dynamics are going to drive it forward. I think when we talk in that 3 to 5 year range, rather than like say next year, but if you look in that longer term range, I think the problems you talked about earlier regarding kind of a fiscal spiral become relevant on that kind of time frame, because I think there's going to be a situation where it becomes apparent that no matter how high you raise interest rates, you don't necessarily quell inflation over the longer term. And in some contexts, you could even exacerbate it because you're actually further blowing out the deficit-driven inflation that's happening. And so if you get to a phase where the Fed is still holding rates high, but they have to resume some sort of QE, for example, to fix like a treasury supply problem because there's so much treasuries being issued, that's not really a problem like this year, but it's like, when you talk about that 3 to 5 year time frame, I think you can have like a global oh shit moment where everybody kind of says like they're not actually struggling to get this under control, and what can we buy instead? And I think that's where you see things like gold or Bitcoin, probably both, things like that catch a bid, because there's this kind of right now it's the dynamic is whenever you see either stronger labor prints or stronger inflation prints or Powell talks about higher rates, you get stronger dollar, you get sell off in these other types of monies, and they say, okay, well, they're going to have to get tighter then. And I think there's a eventual phase shift where they realize that no matter how tight they go, because it actually some of that tightness exacerbates the problem, that it's not necessarily that correlation they think it is. And when that correlation breaks down, I think that it gets really interesting for anything that's like alternative money, right? With Bitcoin and gold, depending on the types of markets you're operating in, being the two like soundest.
Yeah, that's where you have the psychological light switch go off, and people are like, oh, they don't have control.
Yeah. Right now they're adamant that basically raising rates is the solution. And I think as long as that psychology is there, it's hard for these other things to catch a bid.
Yeah. But like we mentioned earlier, it's getting to a point where intuitively, like that seems like a logical conundrum, because if you raise rates, I mean, it's most heavily felt in real estate markets right now. Fed funds rates going up, mortgage rates are going up towards 7%. But going back to like solving supply side issues, particularly with like energy, like if you raise the Fed funds rate up to a certain point, like the cost of capital to get out loans to drill new oil and gas wells or start new energy projects gets prohibitive. And then again, going back to the problem we were discussing earlier, that's where you have the supply side problem, where there's not enough supply to meet the demand. And then you have this inflation run away while you're raising rates.
Exactly. I think so. And that's why the path dependence is challenging here, because raising rates can reduce demand and inflation pressures in the real estate market, right? Because they use debt so heavily. It also is having a big impact on unprofitable tech companies, because they've been very reliant on structurally high equity valuations and constantly issuing new equity in lieu of profitability. Obviously, that's fine for startups, but if you're a mature company and that's like your perpetual business model, that's malinvestment. That's a problem, and a lot of that's being cleared out right now, because in higher rates, kind of like how real estate gets hit, that unprofitable, high equity focused tech gets hit, because then it compounds on itself, because then you realize, okay, now that they have to raise prices to make up for the fact that they're not able to constantly issue as much high value equity, and when they raise prices, their growth rates go down, because their growth rates were only at the level they were because of artificially low pricing due to not having a mandate to be profitable. And so real estate and tech are the two areas that are adding some degree of disinflation to the mix, I think, going forward, because you're going to have in some ways stagnant prices. You're going to have less overall activity in those areas. And I think the Fed's basically hoping that that's enough to counterbalance a lot of the other inflationary forces, which are energy, which are labor shortages among people who make stuff and maintain stuff, and the fiscal driven inflation. And so I think we're in this awkward phase, like now, maybe the next year, where those two forces, it's kind of hard to say which one's going to win over like a 12-month period. That's why it's, I think we still could get this period of disinflation ahead. But then when you look out, 24 months or, 3 to 5 years, I think certainly those inflationary forces are stronger and can override some of the tightening that they can do in some of the most interest rate sensitive industries. And when that happens, I think you get a trend shift in psychology. I think you get big questions around Fed independence and politicization of Fed activity. And I think actually one of the things that challenges that is we're about a week or two away from the Fed having negative tangible equity, which is interesting, because now they're operating at a loss, and they've been operating a loss since September. And those losses have now piled up such that they are about to equal their existing equity. And so that's going to start raising independence questions, and it gives certain congressmen that don't like what the Fed's doing another avenue to kind of go after them.
Look at them. They're unprofitable. We need to nationalize the Fed. This is something you've been covering since it started happening in September, which is, so the Fed is losing more and more money month on month as they raise rates. And so who does this affect at the end of the day? So the Fed member, so who actually owns stakes in the Federal Reserve, right? It's a lot of the commercial banks and Fed members. Does this affect them at all?
Well, the funny thing is it probably affects them positively, because even though they own a stake in the Fed, the fact that so if you back up for a second, the Fed, just like many other banks, has assets and liabilities. And for the Fed, the assets are things like treasuries and mortgage-backed securities, which are on average longer duration and were locked in at these lower interest rates of old. Now, their liabilities are one, banknotes, which are the zero interest rate portion of their liabilities. So they've, that's nice for them. But then their other major liabilities are bank reserves and reverse repos. So banks store their excess cash at the Fed, just like we store our cash at the bank. And so they get paid interest by the Fed on those reserves and reverse repos. And the Fed's paying out very high interest rates on those things, which are ironically mostly going to banks and money markets. So the fact that the Fed raised rates so much, they spent decades in a period where their assets paid a higher level of interest than their liabilities. So they were consistently profitable, and they'd have to give their excess profits to the Treasury. And now, because they've raised their interest rates so much, the interest rates on their liabilities exceed the interest rates on their assets. So they're operating at a loss. So the first fatality of this whole arrangement is that they're no longer sending money to the Treasury. So the Treasury had a $100 billion a year income source from the Fed that is just gone now, and it's gone for quite a while. And $100 billion doesn't seem like much these days, but that's 4 NASA's worth of income, right? And that's 4 times NASA's annual budget. It's just gone. Fairy dust. It's gone. And instead, it's going towards the banking system, right? So the banks are actually doing okay with that arrangement. And so I think you're going to and then, the longer term threat is that you're going to get senators and Congress people being like, hey, why are you trying to squash labor? And by the way, why are you paying all this money to banks? And why do you have negative tangible equity? Because they're actually using accounting kind of tricks to hide the fact that their equity is going down, right? They actually record all their losses as assets. So it's kind of like magic, but basically that's why I say tangible equity. Like if you actually, factor out their weird accounting, it's negative tangible equity, or at least about to be in about a week or two. And I think that's you're going to get politicization of the Fed in the sense that you're going to have basically really easy ways for like Congress people that don't like the Fed to troll it better, because you have those 2 avenues to attack now that you didn't necessarily have in the years prior.
It's so tiresome. It's the back and forth, because that's weird. It's like it puts you in a position. It's like you can see why the Fed is doing this. Like their hand has been forced to a certain extent, not primarily, but definitely materially driven by the inability of the government on the fiscal side to clean their house up. It just seems like we need to get away from this back and forth interaction between the two, maybe separate money from these institutions altogether. Because again, it's the way you describe all this, it's hard not to be a bit pessimistic about the future of the U.S., particularly from a financial standpoint, economic standpoint. Like, what is the silver lining here? Is there one? Do you see a glimmer of hope moving forward for the U.S.?
I think the silver lining is that the foreign sector is a mess too. So if you kind of go through the list of major economic blocks, I mean, the United States, we have the problem of, structural trade deficits, very high levels of political polarization because of some of these imbalances in the system, and the fact that, if foreigners stop buying our treasuries on a structural basis, as they kind of already have, especially the official sector, that gets really ugly for the United States pretty quick. That's our downside. But our upside is that, we have a lot of natural resources. We have still some of the best rule of law and some of the most dynamic kind of entrepreneurial, tech-driven, ecosystem. So we certainly have strengths. We have basically the best geography in terms of agriculture, river systems, access to coasts, friendly borders compared to, the number of borders that like China has to deal with. So we have both strengths and weaknesses. If you look at Europe, they have a worse demographic situation than the United States. They have now a worse energy situation because, they've lost their access to cheap Russian gas, and now they have to rely more on LNG, which is more expensive. They have to build all this infrastructure. They've kind of the German model has been reliant on arbitraging cheap Russian gas to make all these products that the rest of the world, especially China, consumes. But large portion of the world, everybody buys Mercedes. So that's I'm not very bullish on Europe in general, and they also have a more complex fiscal and monetary arrangement because like imagine if the United States, instead of having basically it's like if all the states had their own social security systems, and some were they have that in the pension side, but imagine if you had even more debt on the state level, and the types of polarization you'd have from different policies. That's basically the problem over in Europe, right? You have basically a monetary union without a fiscal union that I think is kind of destined to run off the rails in a significant way. So I think that's challenging them. And if you look at China, I mean, one, you authoritarian genocidal state, so there's that. But then even just from a pragmatic standpoint, they have a demographics peak. They have some of the worst demographics going forward in the world, and so they have strengths like their the power of their industrial base. I mean, they produce more electricity. They have a huge industrial base. They're effective at building infrastructure, including for projects around the world. But they do have a demographics problem and a freedom problem. And so there's really no center of power really that's better than the United States. It's just I think that it's becoming less U.S. dominant instead of U.S. being the only game in town like it was after World War II, and for several decades, it's just increasingly this multipolar world. And so I think there's going to be spots that are better than others, but I think it's just a challenge that the world has to work through in terms of energy and failing money systems for the next decade or more.
Yeah, there's trouble all over the world, freaks. But it's bringing it back to energy. Do you think the lessons learned last year, particularly, are going to drive a tectonic shift in energy policy moving forward, or do you think it hasn't been enough?
I don't think it's been enough yet. I think the rhetoric out of Europe shows it's not been enough. I think in the U.S. we're not seeing a sea change yet. I think basically until you see a radical kind of push towards nuclear, I think that as long as that's not happening, then there's been no sea change. Even things OTEC, ocean thermal energy conversion. I think those types of technologies are interesting to explore because it's actually, kind of stored up energy that's accessible. The fact that there's still kind of lackluster interest, most people don't know what it is. I don't think people realize just the challenges that are ahead of us in terms of global kind of dense energy sources. And there's been really no sign that this is underway. I still see people talking, when they talk about energy transition, they always are focusing on solar, wind, and batteries. And they seem to underestimate how much metals you need for all of that and how much hydrocarbons it takes to get all those metals, let alone if you just do the math on copper and say, okay, well, how long does it take to build a copper mine? How many copper mines do we have? How much copper would we need if XYZ assumptions about electrification are, happen? And it's the gap is just enormous, by the time you get out into the late 2020s into the 2030s. And so I think there's not been yet a realization about the importance of dense energy and kind of reliable plans for long-term sustainability, rather than that the emphasis is always on scoring points over the next couple quarters, or saying hey, I do this and therefore I feel good, even though what I did isn't necessarily helping anyone, right? That kind of thing. I think we have to get out of that mindset and towards long-term engineering, which is how do you make nuclear better? Can you get OTEC economical? Can you, advance geothermal, right? Can you, improve energy distribution infrastructure? I think that kind of stuff's just still not serious.
No, I completely agree. And that's particularly here in the States. It's one thing watching the All In podcast over the last few weeks. Chamath has been really leaning into solar is the cheapest energy that we have right now. It's going to drive this cheap energy revolution that we don't understand. And number one, like you mentioned, I don't think he's being completely honest about the bridge necessary in terms of the rare earth metals needed to actually build out that infrastructure and all the energy and infrastructure that would be necessary for that. And then number two, I think what does the public a mass disservice, particularly from solar and wind, is they leverage this metric LCOE, like the levelized cost of energy, which isn't wholly reflective of the actual cost. It's just the cost to produce as it's producing. It doesn't factor in the cost of the natural gas plant that needs to be spun up overnight to supply energy when the sun's not shining. And there's just like a lot of confusion and rhetoric being pushed that is doing a disservice to humanity at the end of the day, I believe.
Yeah, the cost to having continuous energy or energy on demand is obviously a very different metric than the cost of highly variable energy that is there kind of when nature allows it. And it's, a lot of people point towards that cost curve of solar over the past decade, but a lot of that is you were in a massive commodity bear market, right? So the costs of commodities to produce these things went down a ton. Making solar panels is very energy intensive, and you had a multi-year energy bear market, including coal for a while. Something like 80% of solar panels are like made in China with coal. And so you had this kind of structural downward curve in solar, which is in the past couple of years now on an uptrend because the inputs are more expensive. And if you want to have your solar panels made domestically rather than, in China, that's going to add a big cost layer as well. And so it's not that I'm opposed to solar, especially in certain environments we have very, very strong sun and where you want that degree of generation independence. I think Africa could be a pretty big solar market, for example. I think solar is a potential mix, but I think that the problem comes when people assign too much to it and kind of push something that is not going to work on a market scale while ignoring some of the more dense energy sources that can work all the time. Things like nuclear, for example.
Yeah, nuclear is such a no-brainer. There has been some positive developments here in the U.S. particularly. I think one of the companies building out small modular reactors has gotten through some of the red tape and will begin deploying some of those reactors at some point this decade. But I completely agree. There needs to be a massive shift in leading into nuclear. Like, hey, this is the densest form of energy we have. We obviously need more cheap, abundant energy. Like, I think, yes, Chernobyl was bad, Fukushima is bad, but those are lessons we can learn from. And there are ways to do it much safer than we were doing decades ago.
Yeah, it's like the statistics of plane crashes, right? Plane travel is very safe, but obviously every once in a while there's like this headline incident that is like horrifying, and so that kind of gets into our psyches. The same thing's true for nuclear. If you run the numbers, even if you assume the worst like death tolls from all the radiation from those nuclear disasters, it's still way, way, way fewer people than like the number of people that die from coal like every year, for example, just from like the pollution from particulates, right? So it's like we understate, and this happens like with driving cars too. We underestimate the risk of driving a car on a daily basis while we overestimate the risk of air travel. And similarly, we underestimate the risk of either not having enough energy or some of the dirtier types of energy, and we overestimate the risk of things like nuclear because they're scary, they're unknown, and when they go wrong, they really go wrong. And then there's the other factor that most of those even though those instances occurred in different decades, they were all with like 60s and 70s technology. They were all kind of the same era of technology. Chernobyl in particular was a dumpster fire. I mean, they didn't even have like basic safety precautions that allowed it to get so bad. Whereas now modern plants and then the additional development of small nuclear reactors, I think is a huge thing. Like imagine if we just never shifted away from nuclear like we did. If we had better R&D this whole time and more professionals working in it, I think we'd be further ahead than we are now. But even now we have very, very promising technologies that if we were to be serious about them, I think can at least smooth out a lot of the energy problems that we face in the years ahead. And I think like you said, there's early signs of an awareness of this. And I think that, if you have a handful of more energy crises, I think that they're going to be cumulative in the sense that more and more people will want to learn about energy and want to know how to solve these problems that keep happening to them. And I think that they'll become more aware of nuclear, become more aware of other dense energy sources. Hopefully become more aware of Bitcoin mining as like demand response, for example. I think there's this kind of this all of the above that has to take place, and I think there's going to be this like kind of harsh period that has to kind of wash out misconceptions people have around energy.
Yeah. So do you foresee a harsh period coming in the coming years? I mean, obviously, a lot of people have been talking about China reopening, stoking demand for oil and gas, particularly, and driving up the prices of those commodities, which could lead to energy crises. Are you seeing that as well, or is that just a meme?
I mean, I think it's a factor. It depends how fast they try to open, right? So, for example, you've seen a pretty good resurgence of domestic Chinese air travel. There's still, their international air travel is still, significantly below prior trends. Their level of construction, we shouldn't probably expect as we've seen before, because, they've already got, now that their population is basically, flat down. But I do think it is around the margins a factor. And I think the longer term factors are that countries like India and others that are just kind of using more and more energy every year are going to continue that just step by step pace of more and more energy. And so I think if you look at region, right, so natural gas is kind of this more local market. I think, there's still a couple winners of challenges ahead for Europe. They have to really kind of get this LNG online. Luckily, we're building a lot of LNG export in the United States that can help smooth that out in the coming years. But I think there's still kind of a danger period. But I do think the potentially the global issue is kind of the price of oil. And I think that, I don't have a crystal ball for the timing, but I think until we see a significant supply side response to kind of structurally higher prices, I think we're going to be in this period where whenever we try to have a period of global growth, you're going to get basically oil price coming right back and being a problem. And so I do think that we're going to have kind of waves of energy crises. Hopefully nothing as bad as what Europe had, at the worst phase. But I do think you can have periods like that where certain energy commodities go like vertical in price because just the supply side is messy in terms of both production and distribution. And I do think it's going to be just a recurring set of lessons we have to go through that's probably going to be pretty harsh for 5, 10 or more years.
Yeah. Yeah, it's crazy that we've gotten so far away from reality as a society where many people in positions of power don't realize the importance of energy and what it means for the quality of life for all humans on the planet. And that is the weird paradox that the West finds itself in now, trying to like virtue signal about climate change and moving towards this green energy revolution. Then, like you mentioned, you have countries like India that are pulling themselves out of poverty, and they see what we've done here in the West. They're like, hey, we want to get on par with you, so we're going to do the same thing that you did, leverage these hydrocarbons to fuel our economy. And there's just like this weird political rhetoric that puts the U.S. in a bit of a paradox. Like, who are we to build up our economy with hydrocarbons, become the largest empire the earth has ever seen, and turn around and say, no, you can't do that.
Yeah, and the same thing happened with Europe. I mean, they were like, trying to convince a lot of countries to like use less coal, use less hydrocarbons in general. And as soon as they had an energy crisis, they were like, okay, we need all the coal now, right?
Yeah.
And it's like, well, like they want it even more because they're using less of it now, and they want the basic quality of life that comes with a reasonable amount of energy. And I do think that's going to be a big theme. And I think that good times allow for luxury beliefs to proliferate, and going through harder times kind of scratches away those luxury beliefs. And the risk, in my view, is that it can also create extremist beliefs, and blaming the wrong group for the problem, right? And that's kind of this theme that reoccurs in history, that when you go through harder times, you really have to focus on what the actual problem is, which is things like energy supply and broken money systems, and things like that. Whereas I think the risk is that you end up blaming all sorts of other groups, often the most disadvantaged groups to begin with, and that's not good for anyone, right? And so I think that's another key risk is when you analyze how bad things get versus how promising things could get. I think it's how society handles those challenges. Do they identify the correct problems quickly enough, or do they go off on weird tangents, things like that?
And I think, particularly right now, it's very important to get this message out there because we're finding ourselves at a point where the U.S. economy is sort of teetering on the edge, the global economy is sort of teetering on the edge, and we've seen it in the last 2 months very acutely is the saber rattling. The war drums are slowly beginning to beat, and that's typically what happens when governments lose control of their economies and of their societies. They distract the populace with war in some foreign land, and that seems to be the trend that's growing right now, which is a bit scary and something I think about often is like, how do we get out in front of that, get to people and say, hey, look, they're trying to send you the war. Your problem's not with those people in the far off land. It is these structural problems, the energy systems, the monetary system, and the fiscal problems that you have in your own country. Like, I mean, I'm rambling right now, but it's like, how do we get that message out there to the wider populace to really not go down the path of war? Because war at the scale that it would be today would not be good for anybody on the planet.
I don't know the answer. I think it's just one person at a time. Two messages I would have is one is that, inflation leads to war and war leads to inflation. So you really don't want to exacerbate. Basically, when the pie is not growing, when there's supply side issues, countries are more likely to fight for those remaining supplies. But then ironically, because you're creating all those frictions, you're now shrinking the pie. So you might get a bigger piece of a smaller pie if you're victorious. And if you lose, you get a smaller piece of a smaller pie. And so that's just one challenge. And then the other one is that the costs of war are often abstracted away from us. And I did a recent tweet maybe a week ago or something like that where I looked back on the cost of the war in Iraq, for example. And because it's more relevant now because a lot of the cost is actually the accumulated debt we had from it. You had all these military operations, you had all these other things, and a lot of it was financed by debt. And now the interest on that debt is being refinanced at higher rates. So actually the higher interest rates go, the more in retrospect that war was expensive to us. And, it's up to something like an estimated 5.8 trillion, all factors considered. And, the forecasts up through like 2050 are like, something like 13 trillion because those debts and other things keep, the what we owe to war veterans in terms of healthcare and what we owe on the debt compounded over time will keep growing. And at the time, in 2003, something like 76% of Americans at the peak were in favor of invading Iraq. And so, but it's like if you then reran that poll and said, okay, do you want to pay a 10% income tax for the war to cover the cost now? What would that number be? Right? It's like if the cost is abstracted away from them, they're like, yeah, I don't know, go do war. I'm a patriot. But if you actually say, okay, like here's the actual breakdown of what this means, let alone ethics and violence and all that. It's just like if you had to actually pay for it, how does this impact your life? And I think one thing we want to focus on this decade is like if people either get aggressive internationally or they start getting tribal at home, it's like, well, let's actually examine the cost of what you're proposing. And that's something I'm going to try to keep hammering on.
Yeah, here's a picture of your future paycheck with the war tax taken out. Are you sure you want to do this?
Yeah.
Yeah. I have hope. I think in the age of social media and immediate communication technologies and the proliferation of more open communication protocols like Nostr, we will have the ability to get these messages out. Some people think I'm naive to think that, but I do. I do think it's possible. And I do think we have seen examples of this in the last decade, particularly around Syria. I do think social media played a role in curbing that war, but it's really getting out there and educating people about the structural underlying problems that war is used as a distraction from. And there's a lot to be hopeful for, particularly with Bitcoin. Like there's so much to build. There's so much promise. There's so much accessibility from a global perspective that I think as Bitcoiners, I think that's one thing we need to, and not we, but one thing I try to be better at is highlighting the opportunity that exists building on top of the Bitcoin protocol.
I agree. If I didn't have Bitcoin to cover, I'd be more pessimistic because I'd be covering just basically problems with fewer solutions. And instead, it's kind of this mix of pessimism and optimism because you're covering problems, but you're also covering potential solutions. And so both in energy and in money, there are severe problems in the present, but there are, technologies that make this better over time. And so the goal is kind of like, okay, let's write about the problems. Let's write about some of the solutions. Let's be honest about some of the risks of these solutions. And so what hurdles are still there? Like, let's explore this. And I think the more people do that, the more hopeful people can get about, how to fix this. And part of that is understanding the problems of the current system. So I do try to be optimistic. I'm generally optimistic. And it just basically comes down to, I think, going through a period of hard times and making sure people don't learn the wrong lessons from those hard times, and that instead they learn the right lessons from the hard times, because then you have an era of hopefully abundance after those hard times. Agreed.
Actually, I think the silver lining to a lot of these tech sector layoffs is going to be there's a bunch of Bitcoiners at a lot of these companies who are very talented, who now have time to actually focus on a solution and go build products that bring a Bitcoin standard about. I did have one question that I wanted to ask earlier, but I do want to ask it, and it's sort of disconnected from the train of thought that we're on right now, but it ties in. I forget who I was discussing this with yesterday, but how much does, going back to like employment and Fed policy, like there's many people who are working 2-3 jobs now. Is that factored into any of the policy decisions that the Fed is making? And if not, how is it creating a blind spot for them?
So I do think they try to look at different types of metrics to make sure that things are measuring out wrong. I don't have a high assessment of their probability of reading the data accurately. I mean, generally they're looking at lagging data. There's also, there are, you can look at job openings. You can look at temporary jobs. You can look at overtime hours. You can look at full-time employment. You can look at, like you said, multiple jobs. You can look to see, are there certain areas that are booming and ones that are not? And I generally think that they're probably not going to take into account that data very well. Right now, if you look at the labor market, what's pretty weak is temporary help services and overtime hours. Those have drifted downward, implying kind of they're like early leading more volatile signs of labor softness. Because if you're a business, the first thing you're going to do is hire less temporary help and reduce your overtime before you consider laying people off. And so I think we're seeing early signs of labor softness. But I think the bigger problem with how they measure this is just the entire thesis that unemployment and inflation are somehow inversely correlated, right? There are periods of time where they can be, but they're often not. And I think probably the biggest risk that the Fed faces is the idea that they're deliberately trying to have fewer people working, which means less products and services, and higher interest on the government debt, which means even more money pouring into the private sector from that source of money creation. And that's probably not the right mix that they're aiming for in terms of getting prices down in a way that, you can get them down temporarily, but it's like what everybody wants when they say they want low inflation is they want disinflationary growth, right? They want things to get better and for prices to be stable. Whereas if they're trying to do a trade-off between inflation versus like a recession, it's not a very attractive arrangement. And so I kind of question their whole premise of operation. But I think that's something that they have to go through. Instead of kind of complaining about it, it's like, well, let's see how this plays out, and we'll see what lessons people learned from it over time. And I think that overall, that'll be more people challenging the Fed, questioning the Fed. And I don't really blame Jerome Powell too much. I mean, I think, ever since he came in, he's been trying to be more hawkish than his predecessors. He's been trying to tighten up monetary policy to varying degrees. He's more transparent with some of his just descriptions of things than some of his predecessors. Basically, there's limitations on how transparent you can be when you're running the Fed. But I think he's it's not that I don't think he as a person is a problem. I think the premise of the institution is kind of the problem. But I think that in some ways it's a good thing for that to get explored and made more transparent, because then more people see the problems. But it's also going to be a hard time as people go through the problems. And everybody has like a armchair opinion on what the Fed should do. And it's like, well, they're going to do what they're going to do. We're going to see the outcomes. And right now, I think the outcome is that they're sticking to this idea that inflation and labor are kind of inversely correlated, and that raising rates will quell inflation, because I think they're fighting 1970 style inflation with they're fighting 1940 style inflation with 1970s policy, which I don't think is going to go well. But yeah, I'm not very optimistic on their ability to navigate this well.
Yeah, don't hate the player, hate the game. And the game is going to force a very expensive lesson on the American economy and the global economy at large. Yeah, fun times.
Yeah.
Thank God for Bitcoin.
I agree.
Lyn.
Yeah, got something to distract us and work on, and be optimistic about.
Yes, extremely optimistic. And thank God is there to keep me busy, because, like you said, if I were forced to be immersed in just doom and gloom day in and day out, I don't know how that would be for my mental health or my outlook on the future. Tough times.
Yeah,
we'll create
I
stronger.
agree.
We'll create stronger men and women in the future. So I think tough lessons we need to learn. And luckily we have people like you getting out there, educating people about the structural problems and the core of these problems, so that they can better understand and make better decisions moving forward. So Lyn, I want to thank you for taking some time to sit back down. It's been too long.
I agree. Yeah, hopefully we'll run into each other at one of these conferences one of these days.
It's not too late to book a ticket to the Bitcoin takeover event here in the Commons in a couple weeks. It's actually next week.
I'll look into it.
Where can people find out more about where you're writing, where you're sharing your thoughts?
LynAlden.com is my hub for most of my content. I'm also active on Twitter at Lyn Alden Contact, so people can check that out. I write for Swan, but then after a while I do republish them on my site as well. So I recently wrote an article about open monetary and information networks, kind of just observations around the implications of what things like Bitcoin and Nostr mean compared to the existing kind of closed, siloed systems. So people can check out that.
Go check it out. LynAlden.com. And if you're not following Lyn on Twitter, you're doing yourself a disservice, so go follow her. Lyn.
And I'm on Nostr. I'm on Nostr too. I should actually, it's pretty relevant. Yeah, I'm basically on there. I try to be active. I definitely like to explore. Over the past few months, I've been exploring that ecosystem. So
I'll let you pull out your phone. You can pull up your MPub and read that to the freaks as well. They can. I'm kidding. Go follow Lyn on Nostr. Lyn, you enjoy the rest of your day.
Yep, you too.
All right, that's all we got today, freaks. Peace and love. Tiki!